If you are 65 or older and your net income sits under $45,000, there is one line on your tax return that is quietly costing you $1,289 every single year. The CRA will not call to tell you about it. Your tax software will not flag it either. It just sits there, unused, year after year. Most retirees look at their return, see a balance owing of zero, and assume they have won. But for a lot of couples, that zero often means real money got left behind, because nobody moved an unused credit from one spouse's return to the other's. That is close to what plenty of households set aside for a single property tax installment, gone because one form got skipped. This is not about being careless. It is about a system that assumes you already know which boxes exist. You paid into it for decades. It does not exactly advertise the parts that say you back. The form sits 3 clicks deep on a site built for accountants, not for someone filing their own return once a year. We are going to walk through 5 tax breaks the CRA actually built for people your age. Real credits, real mechanisms, worth claiming properly. But one of them comes with a warning most finance channels skip. There is a popular move, a small RRIF withdrawal, that gets recommended to almost everyone the year they turn 65. For most retirees, it works exactly as advertised. For anyone sitting close to the guaranteed income supplement threshold, that same withdrawal can trigger a clawback worth more than the credit itself. We will also get into the credit that quietly changed its name in 2026, and the one home renovation rule, the CRA, closed the same year, because a lot of the advice still floating around is written for the version of these rules that no longer exists. Before we get to any of the 5, we need to fix the trap that quietly cancels out the first one. For the 2026 tax year, the age amount sits at $9,208. That is not a deduction. It is a federal credit, and at the current lowest rate of 14%, it is worth $1,289 straight off your tax bill, the exact number we started with. Every Canadian turns 65 exactly once, and this credit shows up automatically the year you do, whether you notice it or not. Here is the part that trips people up. This credit is non-refundable. If you only owe $400 in federal tax before applying it, the credit wipes out that $400 and the remaining $889 simply disappears. It does not carry forward, and it does not show up as a refund. The same way an unused vacation day expires at year end instead of rolling into the next one. You worked for this money for most of your adult life. Leaving $889 of it unclaimed is not caution. It is an accidental donation to the federal treasury, and nobody signs up for that on purpose. It happens because the credit only pays out against tax you actually owe, and a lot of retirees in their first few years off work simply do not owe enough. Now here is the reversal a lot of people never hear. If your income is too low to use the full credit yourself, you are not stuck. Schedule 2, line 32600, lets you transfer the unused portion to your spouse or common law partner, so it reduces their tax bill instead of vanishing. Most couples never do this because nobody at tax time mentions the option exists, and most tax software will not prompt you for it unless you already know to look. Think about a retired couple where one spouse has $22,000 in income and owes roughly $400 in tax. Without the transfer, $889 of that spouse's age credit disappears every single year. With it, the same $889 shows up on the higher earning spouse's return instead, lowering what that spouse owes dollar for dollar. Same household, same income, nearly $900 different, based on one box being checked on one schedule. Skip that box for 10 years running, and the gap compounds quietly in the background. 10 years of the same $889 disappearing works out to close to $8,900 that never left your bank account, not because you spent it somewhere else, but because it was never claimed in the first place. That is not a one-time miss. It is a habit that repeats every spring unless something changes. That takes care of the credit almost everyone qualifies for. The next one only shows up if you already have the right kind of income, and that is where a popular piece of advice starts causing real damage. The pension income amount, line 3400, gives you a credit on the first $2,000 of eligible pension income each year. CPP and OAS do not count toward it. If those are your only sources of income, this credit is worth exactly zero to you, which is where the RRIF trick comes from. The idea is simple enough. Convert a small slice of your RRSP into a RRIF the year you turn 65, withdraw $2,000 from it, and that withdrawal counts as eligible pension income. Suddenly, you qualify for a credit worth $280 at the current 14% rate. A lot of retirement channels present this as close to free money, and for most people, it is. The mechanism exists specifically because Parliament wanted to reward people who saved into a RRSP, not just people receiving a workplace pension, so it built a workaround into the RRIF rules. But if you receive the Guaranteed Income Supplement, that $2,000 is not free. GIS gets reduced by 50 cents for every dollar of income you report outside of CPP and OAS, and a RRIF withdrawal counts as that kind of income. So the same $2,000 that hands you a $280 tax credit also costs you $1,000 in GIS payments over the following year. The credit and the clawback are calculated by two different parts of government, on two different forms, and neither one checks what the other is doing. Run the two numbers side by side. You gain $280 in tax credit. You lose $1,000 in GIS. Net, you are $720 poorer for making a move a video told you was a guaranteed win. That is close to a full month of groceries for one person, gone because of a withdrawal that looked harmless on paper. I used to recommend this $2,000 RRIF move to almost everyone turning 65. I stopped. I did not weigh the GIS threshold closely enough, and I watched someone lose close to a month's worth of groceries because of it. Nobody involved was careless. The advice just was not built for her income bracket, and it is worth saying plainly, if you have made this same move already, that is not a sign you did something foolish. It is a sign the advice you were given left out a variable. The number that matters here is not the $2,000. It is your GIS eligibility. If your income already sits above the GIS cutoff, or you never received GIS in the first place, this move still works the way it gets advertised, and there is no reason to hold back on it. If GIS is part of your household income, check your notice of assessment before touching your RRSP, because the math flips depending on which side of that line you sit on. The long-term cost of guessing wrong is not a one-time $720. It repeats every year you keep making the same withdrawal without checking. None of this is a reason to avoid a RRIF. Converting an RRSP eventually becomes mandatory anyway. And there are real advantages to starting the flow of income early and smoothing it out over more years instead of all at once later. The point is not to hold back on the conversion itself, only to check the GIS math before choosing how much to withdraw in a year when GIS eligibility is on the table. There is a version of this same mistake hiding in medical expenses too, except this one costs people money for the opposite reason. They are claiming on the wrong spouse's return. Medical expenses only count toward a credit once they pass a threshold, and that threshold is the lesser of 3% of your net income, or $2,890 for the 2026 tax year. Most people already know that part. What they miss is that the CRA lets either spouse claim the household's expenses, and that choice changes the outcome by hundreds of dollars. Picture a couple where one spouse earns $60,000 and the other earns $25,000. The higher earner's threshold is $1,800, since 3% of $60,000 is smaller than $2,890. The lower earner's threshold is only $750. Same household, same receipts, but claiming them on the lower income return clears the bar hundreds of dollars sooner, so more of the bill actually counts toward the credit. The threshold exists, so the credit targets expenses that are genuinely a burden relative to what you earn, not just any prescription refill, which is exactly why the spouse with less income clears it faster. There is a second detail almost nobody uses. The 12-month period you choose for grouping expenses does not have to match the calendar year. You can pick any 12-month window that ends in the year you are filing. So a string of dental work that felt scattered and unclaimable, a crown in the spring, a bridge in the fall, a pharmacy copay that kept showing up in between, can land inside one window that clears the threshold with room to spare. None of this requires new spending. It is the same bills, the same prescriptions you already paid for. The only difference is which return they land on and which 12 months you group them into. A lot of people file the same way every year out of habit, on whichever spouse's return the accountant defaults to, without ever asking whether the other return would clear the threshold faster. Think about what that habit costs over time. If a couple leaves $500 of eligible expenses unclaimed most years, simply because they filed them on the wrong return, that is not a single missed refund. It is a recurring gap that shows up every time the dentist, the optometrist, or the physiotherapist sends a bill. It is worth saying, too, that none of this is about chasing a bigger refund for its own sake. It is about not letting the same set of bills quietly fail to qualify, year after year, purely because of which name sits at the top of the return. That handles the recurring costs. The next credit is built for the expense that shows up once, usually after a fall or a diagnosis changes what your home needs to look like. Picture a 68-year-old homeowner in Calgary who slips getting out of the tub. The fix is a walk-in tub and grab bars, and the invoice comes to $15,000. Plenty of people pay a bill like that, file it under home renovation in their own head, and never mention it to whoever does their taxes. It feels like a repair, not a tax matter, so it never comes up. That is a mistake, because the Home Accessibility Tax Credit, line 31285, exists for exactly this. It covers 14% of up to $20,000 in eligible expenses, which puts the maximum credit at $2,800. On a $15,000 tub and grab bar job, that is real money back, not a rounding error, and it applies whether the work happens after a fall or simply because you are planning ahead for the years when stairs and slick tile stop being a minor inconvenience. Here is where a lot of older advice gets it wrong. For years, people were told they could claim the same renovation under both the Home Accessibility Credit and the Medical Expense Credit, doubling up on one invoice. Starting with the 2026 tax year, the CRA closed that door. The same expense can only be claimed once, under one credit, not both. If you are watching an older video that walks through the double claim as a clever move, that video is describing a rule that no longer exists. So before you file, compare which credit actually gives you the bigger number back, home accessibility or medical, and claim the invoice there. Guessing wrong will not cost you the whole credit, but it can cost you the difference between the two, and on a $15,000 job, that difference is worth doing the math for rather than defaulting to whichever credit your preparer mentions first. The habit that actually pays off has nothing to do with math. It is keeping every invoice for anything permanent you install for safety, a grab bar or a walk-in shower, whether or not you plan to claim it the year you pay for it. Renovations get forgotten fast once the work is done and the house feels normal again, and a shoebox of invoices is worth more at tax time than a sharp memory. That covers the big one-time expenses. The next credit is smaller, but it is the one most low-income retirees walk away from without realizing it. A lot of retirees living on OAS and GIS alone believe they do not need to file a tax return, since they owe nothing. That reasoning makes sense on paper. Why fill out paperwork for a bill of zero? It is not laziness. It is a completely logical read of a system that never explains itself clearly. The problem is that filing is not really about the bill. It is what triggers the benefit payments sitting on the other side of your return, and one of the biggest is a credit most people still call by its old name. You probably know it as the GST-HST credit. The CRA renamed it the Canada Groceries and Essentials Benefit starting in the middle of 2026, and quietly raised the amount by 25% at the same time. A single senior with no dependents can now receive close to $679 a year, paid out quarterly, and none of it depends on owing tax. It shows up whether your balance owing is $0 or $1,000, because it is calculated off your income, not your tax bill. Nobody sends that money automatically. The CRA calculates it from your tax return, so if you have not filed in a few years because your income sits at $0, that benefit has likely sat unclaimed the entire time, quietly resetting to nothing every single quarter it went unpaid. There is also a renewal side to this that trips people up just as often. Even once you start receiving it, GIS and this benefit both get recalculated every year based on your most recent return. So a year with no filing is not just a missed payment for that year. It can quietly pause the payments that follow until a return finally lands and CRA has something to calculate from again. It helps to think of your return less as a bill and more as the paperwork that unlocks a quarterly payment. Filing costs you an afternoon. Not filing costs you a few $100s a year, indefinitely, for as long as the habit continues. 5 tax breaks, and every one of them depends on the same habit, actually using the parts of the return that do not fill themselves in. Check line 302600 if you or your spouse cannot use the full age amount alone, since that single transfer can be worth close to $900 a year for a couple who has never claimed it. Before you touch a RRIF for the pension income credit, check where your income sits relative to the GIS threshold, since that one variable flips the entire trick from a $280 win to a $720 loss. Claim medical expenses on the lower income spouse's return and pick the 12-month window that actually clears the threshold instead of defaulting to the calendar year out of habit. Keep every invoice for a home safety upgrade and choose one credit, home accessibility or medical, not both, when you file it, since the CRA now checks for the overlap. File every year, even at zero income, since the Canada Groceries and Essentials benefit only shows up for people who do, and a gap in filing can quietly pause payments you are already counting on. None of this requires you to become a tax expert. The tax code is complicated, but it is not built to trap you. It is built to reward specific actions that most people never take because nobody walks them through it. You already did the hard part. You built the income, you raised a family or built a career or both, and you paid into this system for decades without complaint. This is just about keeping more of what you earned, not learning a new skill. If this helped you find even $100 you were not claiming before, pass it on to someone who is about to file the same way they did last year. Because most of these lines have been sitting on the return the whole time, waiting for someone to check the box.